Well, Patrick, you know what the show today is going to be about. Interest rates, baby. We are talking interest rates because it finally happened. A quarter point interest rate drops. And my question for you, and I just want to start with the biggest question, and I have so many questions around interest rates, but the first one is, do you think this is the beginning of the gates opening? Like, are the floodgates opening because of this interest rate drop of a quarter point, which was announced last week? What do you think?
Well, there's two things. Number one, I was wrong. There was an actual rate decrease. My call was no rate decreases, maybe even for 2024. So I was wrong. I know you wanted to say it first.
I wasn't even going to say it. I wasn't even going to say it, but now I'm going to say, yes, you were wrong, and I was right.
And I'm happy to be wrong, but I don't think it makes a big difference. Does the floodgates open? No.
Are you sure though? Because look at this chart. Look at this guy. This is a keyboard warrior. No, I don't know Robert. I don't know where. I don't even know Robert. But he posted this very interesting chart that shows how much listings are up since the rate cut already. Listings have definitely gone above, considerably above their kind of top end of the range. So, are you sure this is not the beginning of?
This is one side of the equation. So the floodgate of sellers, apparently it opened up. Everybody is hoping that with that decrease, that quarter point decrease, now my house will sell for more than I paid for it. The floodgate of buyers, well, not so much.
Not so much. Well, we'll see. But it is very, very interesting. And I want to dig into all parts of interest rates because this is the beginning of something. Finally, I think it is the beginning of the cycle changing. We've been calling the bottom of the cycle for a while. Back in the day, Patrick, remember, and people could go back, and I encourage people to go back because we called and you called and we both called the top of the market, and we did it really, really, really well. And I've been yelling from the rooftops now for many, many months saying that we are damn close to the bottom and people should stop trying to time the market perfectly because I think we're close to the bottom. I think this is the last indicator I needed to see in order to call the bottom from my perspective. But you're right. The floodgates didn't necessarily open today, but real estate's a slow moving industry. So I'm curious to see what happens in the next 2 weeks, 2 months, 4 months, 6 months. It's going to be very interesting.
Well, it's still regional, and we always have to go back to the regionality of all of it. But to your point, depending on the region, depending on property type, yes, this is in fact going to be a shift in some markets as to where the cycle is going, where it's heading. And I'll say this, is that for investors, this is the time. It has been the time, but more and more is escalating. Get prepared, start hunting. There's deals out there.
Ladies and gentlemen, welcome to another episode of Rein It In, episode number 41. We've been practicing for 40 episodes, Patrick. Now this is the real deal. This is the real episode 41, and we have a lot to talk about. And I have so many sticky notes in front of me, but they all say one thing, and that's interest rates. We're going to be talking about interest rates, but we're going to look at it from different perspectives. Like, we're going to think about how interest rates and what's the impact on buyers, what's the interest rate and the impact on sellers, what's the interest rates and the impact on the economy, and so on and so forth. But we are talking about interest rates in this episode 41. So get ready.
And if you're still listening, like, subscribe, comment. We want to get those algorithms fired up. Subscribe, hit the bell, notifications.
All right, Patrick, let's dig into more interest rate conversation. I think it's fascinating for me. I have an interesting perspective on this because I was hoping for a quarter point. You thought we weren't going to see it. You didn't think we'd actually see an interest rate drop for the rest of the year, I believe was your rough prediction.
Late,
I believe
so late. If we were
late,
it would be late. Yeah.
I'm glad it came now. Now, that day when it happened, I happened to have a meeting with a mortgage broker I do business with. Been doing business with this gentleman for many, many years. He's a very significant real estate investor here in Peterborough and around the region. And I was curious on his take. So I said to him, listen, I'm interested, Dave. I'm very fascinated by this. I'm happy this is happening. And I think this is like we're finally moving into the right area. He had this perspective, which I thought was fascinating. He said, I actually wish they wouldn't have decreased the interest rate. I wish they would have held on a little longer. And so of course I got curious. I said, well, what do you mean? Like that's an interesting perspective, but what do you mean? Why would you want that? I mean, this guy's he doesn't just sell mortgages. This guy's a big real estate investor himself. I mean, this is really impacting him. And just like it's impacting the rest of us. He said the reason is because the pain was almost at the peak. Like the pain was getting there, and there was pain in the market, but we didn't see enough pain yet. And I was just starting to see the banks, finally, the lenders out there, starting to get creative because the pain was starting to impact them. And when the pain impacts them, they get creative. And he showed me some emails from some various lenders that were doing very special programs. Like, for example, he had one particular lender willing to give 80% loan to value. We haven't seen 80% loan to value in years and years and years and years. They were only giving investors 75%, if not 70%. This lender was going to 80% LTV and was giving people a 100% market rents. They were equating those 100% of the rents to the person's income. Those are two big things, Patrick, that this lender was doing in order to make deals pencil, in order to make deals work. And he said, if we could have held on a little longer, where the pain could have got a bit worse, they all would have came in with these kinds of special programs, and that would have helped more than a quarter point drop. That's a fascinating perspective, Patrick.
Well, I've got a couple of questions that. So, first, I don't think this is going to do enough and is going to have a big, I don't think it's going to move the needle all that much. But interesting that he talks about 100% rental offset. And is that for investors, or is that for first-time home buyers that they'll do that? Because, of course, that we've got the initiative around the self-funding house, and
yes,
2 or 3 of the majors have stepped up and said, if you're buying your first time and you've got an additional suite, an ADU, then guess what? We are prepared to give you 100% rental offset. That's on a home buyer. But you're suggesting, and he's suggesting, that is sometimes the case for investors as well.
100%.
Interesting.
In this case, now that it's obviously pretty exciting to see that, for just for this particular lender. But his thought was, they're all going to start doing this. If the pain gets bad enough, they're all going to start doing this. And Patrick, we've seen this. These are the kinds of things lenders used to do in 2015, 2016, before all the belt tightening, so to speak, started. We used to see these programs. They all went away. And we're on the precipice of maybe some of them coming back. That's exciting.
It is exciting, but I want to just emphasize something here, JG. You happen to be talking to a broker. You're working it every day. I mean, you are in the business of building and construction and investing and property management, all the things you do. It's what you do. It's your business. So you're having a conversation. This, to me, is a signal and a good reason for any investor who's even considering getting out there and going hunting for those opportunities, because they're there. Sit down with one of Rain's trusted partners, with a mortgage broker, investor focused, and start to have these conversations so that when you go out looking for opportunities, because they are there, in advance what's going on. I think this is just a great kind of example of what's going on that the general public doesn't know yet, because it's not really out there. This is kind of like an insider scoop. Good scoop, JG.
It's a good scoop for sure. Yeah, no, I'm really pumped, and I hope actually both things happen at the same time. I think that's probably too much to ask for, but that's what I do, is I ask for too much usually. So, I'd love to see interest rates starts to come down and these creative programs start to ramp up, so that it really gives people a lot of choice, because everyone is feeling incredibly handcuffed. So, that was an interesting perspective from this particular mortgage broker. But Patrick, what do you think? Let's kind of break down the market and talk about interest rates and how they impact the different parts of the market. What are your thoughts on, and I think we should start with the biggest one. Of course, we could talk about buyers. We could talk about sellers. We could talk about, the housing supply. We will talk about all that. But what do you think this quarter point drop is going to do to the economy? What do you think is going to do to the GDP? Does this have a meaningful impact, or is this a big nothing burger, or is it something in the middle?
Well, I think, I don't want to call it a nothing burger, but it's not going to have a huge impact on the economy. Here's what's really going on and behind the scenes. And we have to look at your enthusiasm with a quarter point drop, right? And that is really a indication of market sentiment overall. So people will be hopeful. it'll start to shift the market sentiment, which is the attitude. I don't think it's going to change consumer confidence. I think people are still freaked out at the end of the day about the debt service ratios that are going to, if they don't change it more, in other words, people are already holding back. People are spending less and less and less. Credit card debt is going up. The economy, we have not felt the effects of these rate cuts or these rate increases yet. The lag is just coming through. My point is this: is there some hope now, and will it start to shift the sentiment a little bit? 100%. And we saw that even with the number of sellers going, okay, let's do this. Well, okay, that's a shift that's emotional, right? But then we don't realize, or many don't realize, the lag is still yet to come through the economy. And so will it shift the needle or move the needle much? I don't think so, not economically. I can't make it make sense, but you never know. Sentiment can drive a lot of things, and we'll see what happens over the next, probably 8 weeks.
Well, and I think that's a great point, Patrick. Sentiment is a huge deal, definitely for many parts of the market. But that lag that you're talking about, you said, let's see what it does in 8 weeks. That's what the Bank of Canada is thinking too, by the way. But you and I both know that from a macroeconomic perspective, in order for it to impact the real estate market, it takes up to 18 months for it to flow through the entire economy and actually impact the real estate market. And if you look at this chart here, that is, and you've been saying this, for 18 months now, if you look at Q1 of 2022, that's when they started, raising interest rates. That's the bar where GDP was at 5% for that quarter. It was the highest quarter. Forget that bar in 2021. That was COVID numbers. That doesn't really count. But that, post-COVID, Q1 2022 was the height of the GDP performance. They started tightening, and then look at the GDP since then, just down and down and down and down and down. And I mean, you have to squint to look at that, the latest bar in 2024. You have to squint to see it above zero. So we're essentially now just about to enter that negative GDP road. They know that. That's why they're cutting interest rates. And it's going to take up to 18 months for that to start climbing again, right, Patrick? So it's important for people to realize there's a big lag here in real estate. That's actually a good thing from my perspective. I love that about real estate, because that means I can see the market coming, unlike the stock market, where it's a whole lot more whipsaw up and down much faster. So much more liquid market.
Well, we have to look at what is this all about. So even when we look at these GDP numbers, what's been driving our GDP, I mean, we talk about it frequently, right? Which is Canada's productivity has been in the tank for the longest time. Manufacturing is way down and continues to be down. We're not exporting. We could be one of the richest countries, and we're not. So that is a political kind of view. But aside from that, manufacturing down, productivity down. What's driving our GDP is immigration. And ultimately, we're bringing so many people in that's what's been grinding or giving us the GDP growth, the illusion of strong GDP. The reality of it is, take away that immigration, housing is shut down, manufacturing shuts down, we are low productivity. Arguably, we've been upside down for a number of months. Now, having said all of that, as we start to ramp back up again, the back end lag is going to come through. We've already been seeing unemployment ramp up, but a lot of that unemployment, by the way, is because we've got so much immigration coming in. There's just not enough jobs to accommodate. So these numbers, there's so many little nuances that we can't cover here. And by the way, within the RAIN community, make sure you're coming out to the meetings, because these are some of the nuances we're going to unpack a little bit more to give you some insights. But ultimately, JG, when we look at GDP, this graph is actually going to go into the negative in the coming months, and they'll fake it because of immigration, but ultimately we're really in a recession.
Well, we know GDP per capita, which not GDP per capita, but real GDP, which takes inflation out of the equation, has actually been negative for quite some time, because most of what's been powering the GDP growth, even though it's negligible at best, has been the inflation has been powering that GDP number. And this chart, which was showing you here, is interesting, because this just goes to your point, Patrick, about Canadian manufacturing and how that production is just down and down and down. And in March of 2024, it has hit essentially a low since a year ago. And this is a big. This has a lot to do with Canada's productivity. So it's very, very interesting to see where this is going to go as interest rates come down. And in terms of manufacturing, though, Patrick, a big part of what has to do with manufacturing is exports. What has a big something big to do with exports is our dollar and the strength of that dollar. And I think interest rates, we know that it can have an impact on that. So without getting into a big macroeconomic conversation, there's a lot of entanglement here, I think is the right word. And it's a big puzzle for people to uncover. There's no doubt about that.
And you can't get too buried in all of it, JG. We say this time and again. We say it every time we get on a show. We're talking about where the opportunities live. And so when we look at the economy, investors need to consider how are they going to execute on and take advantage of the opportunities. It goes back to what we said before. Stay in the game, stay engaged, keep paying attention to what's going on economically. Now, given that drop, sit down with a mortgage broker, look at the programs, look how it's shifted. CMHC's also had a shift in theirs. One of our trusted partners, Keith Uti, will be talking to him. I'm going to be talking to him later this week, and we're going to actually release what's going on there.
Now, Patrick, this chart, though, is something I'm going to be keeping an eye on to see what this quarter point cut is going to do to this chart. Maybe nothing, but as you can see, the Real Estate Outlook Index, which talks about confidence in the real estate market, it has been on a climb from the lows of 2023 when kind of it was at the worst point, so to speak. I'm curious to see where this goes. Does this go back to the levels of 2022? Time will tell, but this is a chart that tracks exactly that.
Well, isn't it so interesting, right? Consumer confidence remains at all-time lows, but the real estate sentiment remains at that people are still optimistic about Canadian real estate in spite of the interest rates. But I don't know how those two are going to balance themselves out, given consumer confidence is really low. That will and continues to have an impact on the economy because people are not spending money. I can't even stress how much people have pulled back in general, especially in that kind of lower half of the income, that middle income and down. They're just keeping their hands in their pocket, and even some of the wealthiest.
Yeah, 100%. Now, Patrick, I think, by the way, you asked a good question. I think the answer is, the reason the Real Estate Outlook Index confidence is on its way up and the consumer confidence is on its way down is because most of Canadians have the great majority of their wealth in real estate. So they have got to stay optimistic because essentially it's all in there. Like the whole thing is in real estate just about. And as a result, they got to stay optimistic and they really want this to work out for themselves in the longer term. Whereas consumer confidence, I think it's different. This is, like you said, it's where people are, what are they doing with their money? Are they spending? Are they going to restaurants? Are they buying those additional goods? And the answer is absolutely not. Right now, they have totally tightened up, and that's going to work its way through the economy. And all of this takes a lot of time. So let's get to the second question, which is interest rates and housing supply. What is this going to do for housing supply, Patrick, in terms of this quarter rate interest cut? Are we going to see a whole lot more supply come on the market? Is this going to unlock the construction projects that have been paused? What is it going to do to housing supply?
Well, supply will definitely come on, and that is in terms of people selling. We've already seen some of that chart, and we see that spike. That quarter point is not going to change anything for developers and builders. The math still does not pencil. And then on top of that, I don't think we're going to see, many are sitting on the sidelines waiting for real estate to crash, to come way down. I just don't think it's going to happen. I think you'll see some regions where it is off in some property types. You look at what's happening in the Toronto condo market. I mean, that is an absolute poop show. The number of completions coming on, plus the number of people that are getting out of the condo market, trying to get rid of the deals that they've agreed to. I mean, that is an absolute flood of inventory that's coming up. And so that condo market in Toronto is a mess. It's going to be years before that problem gets handled. And so it'll be interesting to see there. Having said that, detached, I don't think you're going to see a big drop in detached. There's just not enough of it to go around.
Interesting, Patrick. I have a very similar opinion as it relates to housing supply. The resale housing supply, we've already seen that that's come up, but it's only one side of the story. The fact is, though, is the resale housing supply isn't enough. We need new housing supply, and a quarter point interest rate will do absolutely zero for this. And the reason is because that's not the problem. That's not the only problem. There are much bigger problems we have to try to, tackle. Like, for example, I love Daniel's tweet here where he talks about how in 25 years, development charges have gone up 9,000%. Patrick, let me ask you this. If you didn't have a monopoly, you're a business owner, you're a small business owner, just like me. If we weren't the government, we didn't have a monopoly, could we raise our prices 9,000% in 25 years? Like, is that even possible?
It's not even possible. Don't get me going. Don't get me going.
So clearly, politicians are not serious about getting housing built. Development charges, again, going through the roof. Hats off to Doug Ford for what he did with regards to his new bill, because that really helps, because you don't have to pay development charges on that third unit in Ontario. So that's good. But it's more than just that, Patrick. Look at building permits. You can see that we are 168 days slower to issuing, on average, to issuing building permits when we compare ourselves to the United States. It's even much longer if you compare us to like Finland, for example. Point is, it takes a long time in many cities to get building permits. But I will say, Patrick, that this is very municipality based. And most of this number comes from Toronto. So it's a good headline chart, but most of this comes from Toronto. I'm sure Vancouver. I don't know how long Vancouver takes, Patrick. You might know better than I do.
As long or longer
than Toronto. It takes years, like 2-3 years to get a permit, at least a year for sure, to get a permit from Toronto, from the bigger centers. Like in Peterborough, though, Patrick, I submitted for a building permit less than a month ago, and I had a building permit yesterday. So I'm getting building permits in somewhere between 2 to 4 weeks in Peterborough. Same thing in Lindsay, City of Kawartha Lake. Same thing in Orillia. Same thing in Barrie. 2 to 4 weeks is what I'm getting it done. I'm very impressed with the small municipalities. They have really geared up to get permits moving. So that's a good thing.
Well, this goes back to a couple of things that we've talked about in the past. And that is that, the government has this rhetoric that they're going to fix supply, that housing prices are going to come down. And we know that that's just, call it a lie. They could be delusional and actually believe that they're going to pull this off. But when it comes to affordable housing, there's a couple of points. And Trudeau actually said it. Maybe we can find the clip where Trudeau comes out and says that really he said it out loud. We can't afford housing to come off because that would ruin the retirement plans of many. Some version of that statement. Like, he actually said that out loud. So as much as on one side of the equation, they're saying we got to make housing affordable, we got to increase supply, until they start looking after this, none of that is going to happen. And then on the reality of it is politically, if housing prices come down, they're done. They're done anyways. But any politician right now that is really going to force the issues and put in the corrections necessary to bring the cost and potentially bring the cost of real estate down, it's political suicide. They're not going to do it. They need prices to stay where they are.
Yeah, it's a good point, Patrick. So these are all things that impact supply. Quarter rate interest drop, fantastic, doesn't help anything with regards to this. And I think that's just that, and people are going to see that. And there are a lot of people, Patrick, as you mentioned, that are just waiting, saying, oh, the market is going to go even lower. And I'm just thinking, where are you guys? Like, are you guys even looking at the market? Because every single property that I own, Patrick, and that I manage, I get appraisals. I probably get somewhere between 8 to 12 appraisals on a variety of properties every single year. And appraisals are up. In fact, I'm seeing appraisals up. And they're either in the cities I operate in just about every single category. If you're running single family, duplexes, triplexes, small multifamily, your pricing is up. It's not down. Don't believe the headlines. That's what I'm seeing, Patrick. Feet on the street.
100%. And I cannot stress enough is investors, don't let the headlines scare you off. Do the work, lean into this chaos and this confusion, have the conversations with boots on the ground individuals who are actually, like you, JG, as an example, you're in it. You're seeing what's really going on. So talk to your mortgage broker, talk to investor-focused realtors, and you start to get a totally different picture. Opportunities are there. And the good news about it is, JG, is that you've got time. You can write offers. You can be creative with your offers. It changes the game because there's a lot of pain out there. lot of it driven, by the way, by debt service ratios that people are dealing with and that they fear in the near future. So those are opportunities for investors.
All right, Patrick, let's talk about the next topic, which is interest rates and mortgage renewals. How is this quarter point interest rate drop going to impact mortgage renewals? That friend of mine I was telling you about, I was in his office, and I'm not kidding you. As I'm talking to him, it's like ding, ding, ding. And I'm like, what's dinging? He says, that's people emailing me, asking me how much their mortgage is going to go down because of this quarter point interest rate drop. I mean, everyone is wondering that very question is, how much is this going to go down? And the answer is, unfortunately, for most people, this makes no difference unless you're on a variable rate mortgage. Then you'll see a slight decrease. But if you're on a fixed rate mortgage, Patrick, that's not where interest rates come from. They don't come from the Bank of Canada. They come from bond yield. So maybe explain that a little bit.
Well, I mean, depending on, again, and this is really the question is, are you on a variable rate or are you on a fixed rate? So depending on when your mortgage is renewing, I mean, the rough math it's just rough math because there's all sorts of little tweaks and nuances around it. But I think 25 basis points on 100 grand is about $25. So depending, if you had a $500,000 mortgage, you're looking at what is that, about $125 a month that would affect your mortgage payment. So
and that'll make a difference for some. I mean, that'll make a difference for some for sure.
Yeah, 100%. It's a step in the right direction. But to your point, bond yields are still very strong. They've been very erratic. I don't know what they are at the time we're filming this, but the point is that bond yields set the long-term rates, not the Bank of Canada. The challenge that we are facing and that many are facing as we go into 2025, 2026 is that probably, I don't know what the actual math is, but I think 50% of the mortgages that are there are actually renewing in 2025, another 40% in 2026. The debt levels of Canadians is relative to, I think the chart that we have is the 80s is more than double the bad news of what it was in the 80s. The point is this, is that when and if the Bank of Canada does not decrease those rates enough, and we know that they're not coming back to, let's say, 0 or 1 or 2%, many people had those low rates. And at the end of the day, what's going to happen is that it's going to hit people hard. And therein lies the challenge and I guess the real fear of future state. So we'll see what happens. But, if you're even at a 2% mortgage rate or a 2.25% mortgage rate, and you go to, let's say, a low 4, your payments are going up significantly. And so that's going to be a challenge for many Canadians.
Now, a couple things, Patrick. I really want to dig into this because here's the chart you're asking about, which is the mortgage renewals per year. You can see in 2025, we're going to be renewing about 23% of the mortgages renew in 2025. And in 2026, an additional 31%, give or take, are renewing. So between 2025 and 2026, you got over 50% of mortgages are renewing in those 2 years. And I think this is the game right here. I think this is the game the Bank of Canada are playing, which is, and by the way, even though, and I just want everyone to understand this, is even though fixed rate mortgages aren't impacted by variable rate, by the Bank of Canada's overnight rate, even though that is true and that's the facts, as the Bank of Canada overnight rate comes down, bond yields will follow and they will come down too. They definitely follow each other, Patrick. There's lots of evidence to that. So you will see fixed rate mortgages start to come down over time. There's a delay. There's no immediate impact, but you will see that over the course of time, barring anything else crazy happening, that will happen. And I think this is the game the Bank of Canada are playing. They are pushing the limit till the very last possible second, and then they're going to start decreasing because they know this is going to create a lot of pain. And the increase in mortgage payments in 2025 and 2026 is significant. I mean, people who have static payments on a variable, if interest rates don't come down, you're going to see payments going up by 50+% in 2025 and over 60% in 2026. I know the Bank of Canada knows this. They're the source of this chart, and they are just waiting till the last possible second to bring this down. And I don't think they're going to let all this pain happen, but they're going to let some of it happen. That's for sure.
Well, it depends. And there's so many different mortgages out there, JG, as you know. And some of the challenges that are going to be faced is that, as we said early on, when rates started to go up, people really didn't see their payments go up with the rate increases, because what was happening in behind the scenes is, because they have within their mortgage, their payment is not going up. What did they do? They extended amortizations. We shared lots of stories where people at the end of a now 40, 50-year amortization are going to what they're paying for their house is like ridiculous, and what they actually owe is higher than what they started with. Like, the math gets stupid in behind the scenes. So the point is this, is that when people come to renew, all of that reality hits home, and that's where things are really going to come off the rails.
Yeah. And this is the chart, Patrick, that you were referring to a while ago, which is essentially, people like to compare today to the 80s. And even though interest rates aren't as high as they were in the 80s, Patrick, the debt load is a lot higher. Therefore, the actual impact is much greater. And I think this is the chart you were referring to a while ago.
Yeah, that's exactly the chart. And you start to see just how dramatic it is. I mean, it's huge. And this is what is going to come back. This is where the lag will start to really catch up. And it's all to say that, the next couple of years are going to be painful for many.
Now, Patrick, I want to end on this particular note, which is, I've been saying for some time, and it was I believe a year ago, that I can't believe it's June 2024 already, but it was a year ago that I started telling people, listen, eventually interest rates are going to come down and price levels are going to come up. There's no doubt right now a negative correlation between the interest rates as they come down, pricing of real estate is going to go up. That's for sure. You can count on that. It's just statistics, right? And a year ago, I was telling people, listen, you can't control the price of real estate, but so you don't know where it's going to go, but interest rates over time are going to start to come down, and as a result, pricing is going to come up. That, by the way, has already happened in the last year. But now, to me, I think that that's going to get progressively more and more pronounced as time goes on. Now, what's happening, and I'm looking at an analysis I did for a client. It was late last week. I did this analysis for a client because she's looking at doing a self-funding house, Patrick, where she's going to hire Vistor Property Management in order to convert her basement into an income performing asset and actually put a tenant in there and rent it out. And this client is going to have to invest, and I'll give you real numbers. I'm going to look at her numbers here. She's going to have to invest $151,000 in order to convert the basement. It's not cheap to convert a basement into an apartment, because you got to do fire rating and so on and so forth. Without getting all the details, it costs $150,000 to do. But listen to this, Patrick. She purchased that property just a couple of years ago for $440,000. The after repair value, once she does the conversion, is $675,000. So the immediate return on investment is about 55% on her invested $150,000 of renovation. Now, with that, she is going to start to generate $24,000 per year in rental income. That's significant, Patrick, because what happens is, instead of this person now paying her mortgage out of her pocket every single month, she is going to use the rental income to not only pay off the renovation, but also start paying for her mortgage. And listen to this, Patrick. She's going to go from a current cash flow negative, currently, as she pays her own mortgage, she's cash flow negative in a sense. She's cash flow negative $1,200 per month. As she puts the apartment in there, she goes from cash flow negative $1,200 to cash flow negative $100 a month. She's making an additional $1,100 a month. Okay, check this out. I'm not done yet, though. That's pretty incredible already. So you're gonna have somebody who's gonna make 55% return on their investment of investing that into the renovation. They're gonna increase their cash flow every single month by $1,100. That's huge. And when they refinance in November of 2026, they're going to be able to pay off their mortgage, their entire renovation. They're going to be able to pay it all off. They're going to free up $186,000 of free cash flow. And here comes the best part. They will be able to move to another house, go do it again, and that property will generate, and are you ready for this, $2,193 per month in positive cash flow. That is, when you do it right, that is the opportunity, and that's a possibility. And you ask yourself the question, how is this even possible? It's possible because she bought a property, by the way, at the peak of the market, not the bottom, at the peak. She bought it at the peak. She got that low interest rate. She's good. So, but that opportunity goes away, Patrick. And that's what I'm explaining to this client is the minute, like if she doesn't pull this trigger now, this opportunity goes away because when she refinances in 2026, if she doesn't use this low interest rate today, she will lose that opportunity. And a lot of people are sitting in this position right now where they don't want to pull the trigger because they're scared of the future. But if you make the right moves today, real estate is a magical tool. So anyways, I just wanted to share that, Patrick.
Well, listen, JG, I love it. And I'm going to add even one more. We're going to supersize this conversation because when it comes to the self-funding house, the one thing that we have to add to all of this, which is when you go to the bank. So for example, when she eventually buys her second property, you go to the bank, the qualifying income drops significantly because they use 100% of the rental offset when you go to refinance the new property. So if you're a first-time home buyer and you're going to embrace the self-funding house methodology, you're actually going to the bank. And let's say you needed $175,000 of household income to qualify for that mortgage. Guess what? You add an ADU to it, you add the rent to it, and all of a sudden that drops to about $115,000 of household income. So we can't step over the fact that in all of this, financing becomes a huge issue. And when you have that ADU, that additional dwelling unit, in this case, a basement suite, or whatever suite that they're adding, that then it changes the game for what you need to qualify for the next mortgage. So I just want to shine a light on that because banks love it when you have what we would call a mortgage helper, but ultimately that's what it is. It brings your household income, the requirement, way down.
I'm a huge fan, Patrick. In fact, you've inspired me. I'm going to write a blog post case study. I'm going to have it live on the Visture blog today, because by the time this video hits the streets, I want people to see these numbers because I went through it quickly there. But people really got to digest this, Patrick, because this opportunity, and a lot of people are sitting in this beautiful spot, and they got to be able to see the forest through the trees, but they can't because they don't understand the numbers. I will publish the numbers and share with people exactly how this works. So if people go to Visture, visture.ca/blog, we should put that in the show notes, by the way. I'll get it published and we'll show people exactly how to do this, Patrick.
And I want to add one fundamental thing to this, JG, is that, we often go back, we even did it today. We're always comparing to what was the 80s, the 90s, 2019. And we keep comparing to the past. And in this housing market, in this global macroeconomic shift of housing, and it's not just Canada, it's global. The game has changed. And so as those individuals who want to own their first home, the self-funding house, we need to change the tactic. We can live into an old story of what once was, or we can make the change that needs to be made given what's happening in the market. We've shared that whole comment so many times. There is no bad real estate markets. There's just the wrong strategy in any given market. So for those of you who are looking at first time, consider self-funding house. It is the way of the world going forward. Embrace it.
See, Patrick, look how much a quarter point interest rate drop helps. Look at our energy. We're energized. We're enthused. This is awesome. And it's been an absolutely spectacular show. Thanks for doing this. And what a great show. I'm excited for the next quarter point drop. Maybe we're going to get a whole percentage point next time. Who knows? Let's hope.
And watch for more on the self-funding house. Thanks, JG. If you like what you learned here, go to the description below and subscribe for our free Insiders newsletter, where you can also stay up to date for our upcoming events and our courses.